pause for a moment and really think about this. Every single day, millions of people wake up early, rush through traffic, spend 8 to 10 hours at work, and exchange their most valuable asset, time, for money. And after all that effort, most of that money is parked in a bank account that earns almost nothing. It feels safe, but in reality, it is silently losing value every single day. This is not because you are lazy or irresponsible. It is because the system was never designed to teach you how money actually works. Inflation is not loud. It does not knock on your door or announce itself on the news in a way that feels urgent. It slowly eats away at your purchasing power while you are busy living your life. The money you saved 5 years ago can buy less today, and in 5 more years, it will buy even less. If your income rises slower than inflation, you are effectively moving backward. Even if your bank balance looks bigger on paper, the biggest mistake people make is believing they have plenty of time. They think they will start investing someday once things feel more stable. But stability is an illusion. The financial world is changing faster than ever. And by 2026, volatility will not be the exception. It will be the norm. Those who prepare will adapt. Those who delay will struggle. Wealth is not built by luck or excitement. It is built by ownership. When your money works for you, even while you sleep, your life changes. You stop depending entirely on a paycheck. You gain flexibility, confidence, and control. But this only happens when you stop treating money as something to store and can start treating it as something to deploy intelligently. This video is not about get-rich-quick schemes. It is about building a system that protects you from inflation, rewards patience, and compounds over time. You are about to learn focuses on assets that produce real cash, assets that people rely on, regardless of economic cycles. If you feel stuck financially, it is not because you lack discipline. It is because you were never shown a better framework. That changes now. One of the biggest distractions in today's market is hype. Every few years, a new trend captures everyone's attention. Recently, that trend has been artificial intelligence. People rush into companies with exciting stories, but weak fundamentals, hoping to strike it rich overnight. The problem is that stories do not pay bills. Cash flow does. Behind every powerful technology lies something far less glamorous, but far more essential. Energy. Data centers, cloud computing, AI systems, and digital infrastructure all require massive amounts of reliable power. This demand is growing rapidly, and the existing grid is already under strain. You cannot run the future on promises alone. You need fuel, infrastructure, and scale. This is why energy companies play such a critical role moving forward. These businesses are not just oil or gas producers. They are the backbone of modern civilization. They own pipelines, refineries, and distribution networks that took decades to build and are nearly impossible to replicate today due to regulation and cost. That creates a powerful competitive advantage. What makes these companies attractive is not speculation, it is free cash flow. Many established energy firms generate enormous amounts of excess cash and return it directly to shareholders through dividends. While flashy tech stocks may rise and fall violently, energy companies often provide consistent income regardless of market noise. Instead of betting on who will win the next innovation race, owning energy is like owning the toll road that every innovation must travel on. As electricity demand increases, these businesses benefit. As inflation rises, many of them can pass costs along. It makes energy a rare combination of income, stability, and long-term relevance. By focusing on companies that already have strong balance sheets and proven operations, investors reduce risk while still positioning themselves for growth. This is not about chasing excitement. It is about building a foundation that can survive uncertainty and still reward you year after year. Healthcare is another pillar that many investors misunderstand. People often chase small biotech companies with a single experimental drug, hoping for a breakthrough that sends the stock soaring. Sometimes it works, but more often it ends in disappointment. This approach is closer to gambling than investing. A smarter strategy focuses on established healthcare giants. These companies are deeply embedded in the global medical system. They operate across pharmaceuticals, medical devices, and consumer health products. Their scale provides stability, and their diversification reduces risk. If one product underperforms, dozens of others continue generating revenue. Healthcare demand is not optional. As populations age, spending on medicine, treatments, and medical technology increases. People may delay vacations or luxury purchases during economic downturns, but they do not stop caring about their health. This creates a powerful long-term tailwind for the sector. Many of these companies also have long histories of paying and increasing dividends. That means investors are not just hoping for price appreciation, they are being paid consistently to hold the stock. Over time, these growing dividends can outpace inflation and create meaningful passive income. Owning healthcare businesses is essentially owning a slice of a system that society cannot function without. It is resilient, recession-resistant, and deeply integrated into everyday life. When you combine this reliability with disciplined capital allocation, healthcare becomes a cornerstone of sustainable wealth rather than a speculative bet. Consumer staples may seem boring at first glance, but boring is often beautiful in investing. These companies sell products people use every single day: food, beverages, cleaning supplies, and personal care items. Demand for these products remains steady regardless of economic conditions. What makes consumer staples powerful is pricing power. When inflation rises, these companies can gradually increase prices without losing customers. Most people will not stop buying toothpaste or detergent because the price went up slightly. This ability protects profit margins and shareholder returns. Many consumer staple companies generate more cash than they need to reinvest in the business. Their factories and supply chains were built long ago. As a result, excess cash is returned to shareholders through dividends and share buybacks. This creates a steady compounding effect over time. Investors who chase volatility often overlook these businesses because they do not offer dramatic daily price swings. But over decades, their total returns, adjusted for risk, have been exceptional. They allow investors to sleep at night while still building wealth. In a world where uncertainty is increasing, owning companies with predictable demand and consistent cash generation is a powerful advantage. Stability does not mean stagnation, it means resilience. The piece of the puzzle is ownership without unnecessary stress. Many people dream of real estate, but underestimate the time, debt, and responsibility involved in being a landlord. There is another way to gain real estate exposure without managing properties directly. Real estate investment trusts, or REITs, allow investors to own income-producing properties through the stock market. These companies own assets like warehouses, data centers, cell towers, and commercial buildings. By law, they must distribute most of their income to shareholders, which creates reliable cash flow. The advantage of this approach is liquidity and simplicity. You can buy or sell your position instantly, receive regular income, and avoid operational headaches. When structured properly, REITs can provide diversification, inflation protection, and steady returns. As we move toward 2026, the economic environment is likely to remain volatile. Cash alone will continue to lose value. The solution is not panic, it is ownership. Owning energy, healthcare, consumer staples, payment systems, and real assets creates a diversified framework that pays you to wait. At the end of the day, wealth is a choice. You can remain a consumer reacting to the economy, or you can become an owner who benefits from it. The blueprint is simple, but it requires discipline. Start building your system today and let time and compounding do the heavy lifting.